All right, so welcome back to this YouTube channel. So it's King Ruby right here, and I'm gonna be discussing how to rescue your prop account in deep drawdown. Now, this doesn't matter if it's a challenge, if it's a funded account. All of these would help you. Now, there's gonna be some mathematics in this video, and that math is gonna is really going to like bring you out of that drawdown. But then I can't just jump to that math. I must tell you from the start how to first like keep how to arrange your mindset first. You have to understand how to keep your psychology before you're able to do this, because if your psychology is still down, you'll not be able to carry this out. So the first things first, fix your trading first. When you hear me say fix your trading first, for your account to be in a deep drawdown, something is wrong. Okay, I've taught it on my channel that we have three uh three pillars of trading. Like these three things are the pillars of trading, and I'm gonna write them here again. I'm gonna write them here again. Psychology. Okay, so these three things are the most important things in trading. Now, if you're 100% in this one, you're 100% in this one, and you're 100% in this one, you're bound to be a profitable trader. Now, for each of these pillars, psychology is needed to make it work. So psychology is now the most important in the three, because for strategy to be perfect, your psychology must be involved. For your risk management to be A1, 100%, your psychology has to be involved. There's a psychology for it. And for your psychology to be up, psychology has to be involved too. So now talking about strategy, when I say fix your trading based on the first step I mentioned, for you to be in a deep drawdown, either of these are faulty. Either of these three pillars are faulty in your trading. When it comes to strategy, it might probably be you have not gathered enough statistics in your strategy. You have not been able to backtest, or first of all is study. You've not been able to study the strategy, the ins and outs. Because any strategy that has been given to you by maybe a YouTuber or your mentor, you need to study it first. Know the rules of the strategy. Understand it. This will take you weeks, even months, just to study. And in this phase, you shouldn't be using replay, because it will mess up your psychology. That's why I said your strategy is 100%. Psychology is also involved. This study phase requires patience. Patience is psychology. Requires patience. Requires discipline. Discipline how? You are studying what you were taught. You're not going to study what you think you know added to what you were taught. You're studying what you were taught. That framework your mentor has given to you. You are studying that framework to master it, to know it. Now, while doing this, it's important you make use of trading view replay. Not really like trying to take trades with the replay. Okay, I'm back testing now, and I want to see whether I would have made money in this point at that point. No, not yet. You remember you're in the study phase, but trading view replay is still needed. Why? So that I can go back in time and just press play and watch how the candles form, watch how the system is being respected without adding the money factor to it, without trying to take trades in replay, or without trying to gather any statistics. No, you're just watching it, comparing. Now in this phase, you are supposed to have your Notion all set up. Your Notion journal has to be set up. Yes, this is where you have to be writing, dropping screenshots, writing observations about what you found out in your study. Something like this. Okay, so you need something like this. Okay, you see what I'm doing? You need something like this. Something whereby you're putting your screenshots, you're writing all these write-ups, what you notice, you're putting dates, you're adding date to it. This is what you need to be doing in this study phase. That's exactly what you need to be doing. Okay, so inside this study phase, after you've been able to understand the framework, now you move to the back testing. So now when you're backtesting, you're hoping to backtest with bringing out stats. This is where you can make use of FX replay. This is where you can make use of trading view replay too. But you're taking trades actively and you're building statistics. Okay, I'm testing how this thing played out in February with this pair, I played out in October last year with this pair, stuff like that. Now, this is what a lot of people do not do. Now, after this, what's the next? Forward testing. Forward testing is after your back testing has showed you positive result that okay, it's a profitable system. So you have to forward test. Forward test is now you learning it in real time with a demo account, taking trades in real time, making mistakes, fixing your mistakes. Now, you need to have a full 1 week or 2 weeks of not making mistakes and executing the strategy in its full potential. At this stage is when you can think of getting a prop challenge of any sort. This is at this point where you know that okay, I'm not making mistakes again. This is where you can now go and get a prop challenge. But a lot of people do not study, might backtest for a while, and then jump to buy a challenge. And then when they send their challenge to deep drawdown, they come into panic. If you're watching this video, you must if strategy is a problem, either of these three is missing, either forward testing or back testing or studying. So with this, let's assume if that strategy is your problem, that's how to fix it. Go back and do the things I said. Now, if risk management is your problem, it's probably because you were not taught the right way how to risk. You don't even know how much you're risking on every trade. You just use a stable lot size for every trade. Now, using lot size is not risk management. Risk management is the calculation of the number of pips of your stop loss versus how much you intend to risk. The calculation of these two things will bring about what lot size to use. So your lot size is not supposed to be you choosing, it's you calculating it out. The calculation will give you the lot size to use. And if you use that lot size and you lose exactly what you're risking from your balance. That's risk management. So now, risk management also involves how many times you trade in a day. So if you want to trade 2 times max in a day and you risk $50 on a trade, you know that for every day you come to the market, you have $100 on the table. Now, why psychology is also in risk management is that you might make a mistake in your trading strategy and maybe take a bad trade, and you want to revenge by taking a good trade, like when everything now fully aligns, like trying to like cover for your mistake. You might try to do that, and that has exceeded the number of times you're supposed to trade based on your trade management. Means you're supposed to trade just once every day, but that'll make you trade twice. If you're supposed to trade just twice, that'll make you trade thrice. You now forget the fact that the third one could be a loss even if all rules were kept, but the market is in probabilities. So it needs psychology to be disciplined with your risk and say, okay, I'm risking this and I'm not going above. Okay, this looks like an A plus setup. It looks like it's going to work out immediately, but that's not my concern. My concern is I have to come to the market and risk this amount every single day. That's risk management. So your risk management is not driven by how the market looks in your eyes or how clean the setup is. No, it's stable. So it requires discipline, and discipline is psychology. So now the third one, psychology. Psychology in trading means you having your own personal flaws, your own personal inefficiencies. You having this in real life are going to affect your trading. So trying to bad habits of indiscipline, fear, anxiety, self-doubt, and all of these psychological issues, you need to fix them when you're on the chart to give you maximum performance. So if the three is not 100%, you would most likely blow any account you're trading with. So the first things first, like I said, is fixing your trading. So let's go back there. How to fix trading. Okay. So now we are here. How to rescue a prop in deep drawdown. Here we go. So the first is what? Fix your trading first. I've told you how to fix your trading. If any of those three are your issues, work on them. So the next is remove hopes on the account. Now, your account is about to be lost. You're in deep drawdown and you're very scared. The truth is that every professional trader still lose challenges. It's normal. Losing challenges is not a big deal. But the professional traders pass more challenges and they lose. So losing a challenge doesn't define you as a trader. You could be in a bad week, in a bad month, in a bad quarter, and lose challenges because of that. Okay? So remove hopes in the account. That feeling that gives you, that makes you beat up yourself, makes you feel like a worse trader, make you have self-doubt, is from the fact that you think you are the only one that experiences things. No, you're not. So first of all, you have to remove hopes on the account. When it comes to buying of challenges is a business. It's a business whereby you know that you might lose this challenge, but you go ahead and buy it. I'll say it again. You know that you might lose these challenges, but you go ahead and buy it because you know investing wise, you're on an advantage. Meaning, if you have to put in $500 to get a 100K account, then that's a big advantage for you. So it doesn't matter how many 100K challenges you lose. When you actually pass one and eventually get funded, you could get a payout of 10K and you've covered for every of those ones you lost. So financially, it's a good decision. So when you're buying a challenge, you are not hoping that you pass it. You're hoping that you bought a challenge, and like and every other investment, it might work out, it might not work out. So you have to remove hopes on the account. So before you buy challenge, you don't have to buy challenge when you're broke. If you're in Nigeria and watching this, you're broke, and you want to use your last card to buy challenge, you will regret it because you'll be too attached to this account. And everything you're going to watch in this video will not help you. You will suffer. Everything you're going to watch in this video will not even help you. So stop trying to buy challenges when you're broke. Hustle, go and get something to do. Get a job, get any other thing to put money on your bank account. People who buy challenge have a lot of money to buy more if they lose anyone. So you have to remove the hopes on that account and just focus on what I'm going to show you so you can rescue it. And it might work, it might not work, but it has a higher chance of working, especially when you're fixed your trading. That's why I started with it. Now the third, understanding that drawdown percentage is a myth. There is only 10% of that account available to be tradable. So you hear that, okay, you're trading a 5K account, and you hear that, what's the drawdown limit? Drawdown limit is 10%. No, there's nothing like that. It's showing you 5K, but in reality, what's funded in the account is $500. Yes, it's showing 5K, but what's funded in the account is $500. So if you see that account as a $500 account, you would know you have to do some flips to be able to pass that challenge. Yes, you have to do almost 100% flip to pass a challenge. Are you seeing it now? Because the percentage to pass in most programs is 8 to 10%. So if 10% is the money funded in that account, then you need to make a flip for you to get 100%. So $500 is what's that account. That's why if you get to $500, you immediately get breached. Funded or unfunded, it's programmed that $500 is inside. Okay. So now the thing is this: understanding this will make you not see the 5,000, but see the 500. So if you're in a drawdown, let's say your 5K account, you're in a drawdown of $100. What it means is that you have $400 left in that account, no more $500. You should be watching the account based on that drawdown amount. You should be watching the account. So the fourth one is build a risk management plan with the remaining funds. That remaining funds that has suffered after drawdown attack. Now, I'm going to teach you a risk management calculation that would help you bring out that money from there if you follow this. Okay? So, first things first, this trade is moving far against it, far from me. Hopefully, it returns back to entry. But CPI, so you gotta be careful. So, as I was saying, so we have to learn the calculation involved. So now let's assume it's a 5K account and you have lost $200. You have $300 left. That's meaning you have lost $200 in your 5K account. It means the drawdown limit, what is remaining in that account is just $300. If you lose the remaining $300, you have breached the account. So we'll be looking at that 5K account now as a $300 account. So you ask yourself, on this $300, based on my statistics, how much am I going to risk that will make me try at least 10 good times again before I blow this account? I'll say it again. How much am I going to risk on this $300 account so that at least if I trade 10 more times, I'll be able to rescue the account if you 10 more times successful. That's why I said fix your trading first. If your trading is not fixed, you lose all the 10 times. But if your trading is fixed, at least you will be able to trade maybe two, three, four times and bounce back. So inside a $300 account, it takes me to risk $30 per trade to trade 10 times to blow the $300 account, because it takes $30 times 10 to make 300. So it means what I'm gonna be risking is $30 right there. Now, the next thing you're gonna do is this. You're gonna do this x divided by 100 times, I use asterisks, times 300 is equal to 30. So what am I doing right now? I'm trying to find out that $30 you're going to be using out of 300. What percentage is $30 of $300? Okay, so what I'm trying to say is that the $30 you have found that I want to risk now, how many percentage of it is in $300? So that's why I'm using the formula x over 100, x whereby x is the unknown. Okay, that's the unknown amount we want to get. So x divided by 100 times 300 equals to 30. So what we're going to do in this case is that, because this is not, I'm not using pen and paper to write this, so you might not see the cross multiplication factor. So what's going to happen here is on the next line of equation, you're going to be having 300. Oh damn. So the next line of calculation, you're going to be having it like this: 300x divided by 100 equals to 30. Do you see that? 300x, x times 300 is 300, all divided by 100 equals to 30. So in a situation like this, you can do what? Cross multiply. You're going to cross multiply 100 times 30 and 300x times 1. So that would give us, on the next line of equation, that would give us okay, that would give us 300x equal to 30 times 100, that will give you 3000. Okay, that'll give you 3000. So if you're going to cancel, if you're going to do some division for the next line of equation, we're going to have x equal to 3000 divided by 300, and that's gonna end up as what? By 300, and x gonna equal to 10. So what has this shown us? Now I use this formula because it's very easy to just say 10%. Okay, I use this formula, feel me? I use this formula, why? Because it's very easy to say 10%. But what if your balance is not a round figure like 300? What if it's 290 something? What if it's one something? What if it's four something? Something more confusing. So that's why I used this. So now, all right, so now what's going to happen is that you're going to be risking 10% on every single trade based on the balance. So what I'm trying to say is that you're going to be risking $30 for your first trade. Now if you win your first trade, your first trade is going to be you're going to be risking $30. Now if you win your first trade, let's say it's a 2 hour trade, you're going to make $60. So your new drawdown limit or drawdown account balance is going to be 360. So for your next trade, what are you going to risk? You're going to risk 10% of this 360. So 10% of 360 is going to be $36. So what you're going to risk is $36, not $30. Now if you win the $36, that's going to give you a 72 profit. If you add $72 profit to this, that would be giving about a 432. And now the next thing you're gonna do for your next trade, you're going to be risking $43. That's 10% of this, 43.2 rather. You're going to be doing $43.2. It's going to be your next risk. And if you wait, your account keep increasing in speed. Can you see from 300 you have jumped to this without doing anything funny? Now, if you're in a winning streak, it will grow fast. Now, if you're in a losing streak, it will start going down. Now, let's assume we lost our first trade. uh, From the first trade we took, we lost it. That's that's gonna be 300 minus 30 is gonna be 270. So your next risk is going to be what? The next risk is going to be what? $27. If you lose $27 again, what your next risk going to be? Your next balance is gonna be this. So you will risk what? $24.3. So the lower you go on your balance, your drawdown balance, is the lower risk you use. So a losing streak will not readily affect you. So the truth is that even if you lose 10 trades, you might not still blow the 300 again, because your risk is dropping as it goes down. Your risk is dropping as it goes down. And as it goes up, your risk is increasing and you'll get the result fast. So that's exactly how to do it. So let's get back to our notion. So the last is stick to the new plan and do not care about the outcomes. So you might lose your first two, three trades, you might lose your first four trades. Do not care about the outcome. What you care about is sticking to your rules, doing what you have to do, not making silly mistakes. Okay, that's everything. That's every damn thing you need to do to bring out your account. Now, if you still lose every single thing by keeping to your rules, fine, on to the next challenge. But you must always journal your trades and look at them and be sure you do not make any mistakes, or if there's anything to change that causes consistent losses. See you in the next video. Hope you learn from this. Peace out, guys.